boom or a bubble? And what are the implications of either scenario for workers? Today, we are excited to host three leading economists to discuss the economics of the AI infrastructure build-out and the policy implications and questions that people ask. Let me quickly introduce them. I'm going to start with Joseph Briggs. He is a managing director and economist at Goldman Sachs. He was also previously an economist at the Federal Reserve Board of Governors. Next is Mark Zandi. He is the chief economist at Moody's Analytics. He is also the author of 2 books and the host of the Inside Economics podcast. And third, Natasha Sarin. She is a professor at Yale Law School and the president of the Yale Budget Lab. She was formerly a counselor to Treasury Secretary Janet Yellen as well. Thank you all three for joining us.
Thank you, John.
Thanks for having us.
Yeah, excited.
For today's event, we will have a moderated discussion, and I will introduce audience Q&A as part of this discussion, so it'll be interspersed. If you have questions, please send them using the Zoom Q&A feature, or if you're tuning in on our Twitter, leave a question in the replies. So again, if you have questions, please submit them to our Zoom Q&A feature or on Twitter. With that, I'm excited about this panel. I'm going to start with you, Joseph. Can you briefly explain to us what people mean when they talk about the AI infrastructure build-out, and are there any historical parallels that you think of?
Yeah, thanks, John, and great to be here today. On the AI infrastructure build-out, unlocking the enormous economic potential that we see from generative AI is going to require that a lot of people and a lot of the workforce is using AI-enabled application and tools on an everyday basis. And all the queries that are going to go into the automation of work tasks that we think will ultimately occur is going to require a lot of computing power. And, a couple years ago in 2023, when we actually first started looking into AI, we did an exercise where we tried to estimate how much compute investment would be necessary to facilitate the productivity gains that we thought were possible. Our baseline estimate is that we see a 15% uplift to productivity following full adoption. But the estimates that we came up with were wide-ranging, but generally pointed to a capex cycle that rose to the level of several percent of GDP. Over the last several years, we've seen this play out in a meaningful way, whether or not we're looking at the investment in utilities, power, the investment in data centers, which has really been top of mind among our clients for the last year or two. And there's a lot of different ways that you can estimate exactly how much spending on AI investment that we're seeing today. If you look at hyperscaler capex, you get something like a little over 300 billion in investment in 2025, with something like 40% projected growth into 2026. If you look at the amount of spending in the U.S. national accounts that we can directly tie to AI, we come up with a little bit smaller estimate, something like 250 to 300 billion in hardware today. But the point being is that we are seeing something in that 300 billion ballpark of spending on AI-related hardware today, and that this amount is going to rise going forward. Whenever I say 300 billion in AI-related investment, that sounds like a big number, and people's initial reaction is that, everyone's aware that there's that much spending going on right now, but people initially have the take that you're seeing that this is historically unprecedented, that we've never seen this amount of billions of dollars spent before. If you actually benchmark it to the build out of infrastructure necessary to support historical general purpose technologies as a share of GDP, it doesn't look that large. And specifically, if we take that 300 billion number divided by US GDP today, you get to something a little bit less than 1% of GDP. The AI or the infrastructure build-outs we saw associated with telecom and the internet, or with railroads, or the electric motors and the electrification of factories in the early 1900s, all of these investment cycles rose to the tune of 2 to 4% of GDP. And so when benchmarked in this way, the AI investment build out that we're seeing doesn't, from my perspective, look especially large or excessive.
Okay, great. Mark, I'm going to bring you in to comment on what Joseph said and sort of the GDP impacts as you see it of the AI infrastructure build out and AI even more broadly than that that you're seeing right now.
Well, John, let me preface everything I say today on in this conversation with I opine about many things. Some things I'm confident in, some not so much. Everything here would be the not so much. There's just a lot of moving parts, very difficult measurement issues, and it's just difficult to get your mind around all the potential scenarios that might unfold. So I think we need to be very humble, generally humble, but especially so in the context of the conversation today. We estimate our that the contribution to GDP growth in 2025, and that's on a Q4 to Q4 basis, was probably 50, 60 basis points. So about a half a point, a little over a half a point. Of that, about half, maybe a little less than half, is the investment spending that's being done. That's to Joseph's uh, uh, data centers and power and chip investment. And the other half, the wealth effects created by the run-up in AI stocks and the increase in shareholder wealth that created, and that incented a significant increase in spending by the well-to-do, the folks that own the shares. You can see that in saving rates, for example. So I'd say, maybe 20, 25, 30 basis points to the investment, 20, 25, 30 basis points to the wealth effects. I do think there are a lot of measurement issues, particularly around investment. The GDP accounting here is, I think, is vexed, and I'm guessing that once all the data come in and we get all the revisions and kind of because that could be years down the road, that we'll see that that the contribution from investment spending was even larger. I won't go into the weeds about the GDP accounting, but I think it understates the amount of investment that's actually going on and the contribution to growth that's actually occurring.
Would
I
you
will
say it
say
understates?
under that the GDP accounts, when I say 20, 30 basis points,
Yeah.
that understates the contribution to GDP growth that occurred in 2025 from
Okay.
investments. Yeah. If you told me it was double that, I don't know that I'd argue with you. It could be something, that significant. And that would be more consistent with Joseph's kind of other approach to, calculating the amount of investment spending that's actually going on. I will say just, because it helps me get my mind around things, that so far AI's contribution to the economy has been more on the what I call the demand side of the economy. That would be business investment and consumer spending. Less so on the supply side of the economy. That would be the productivity gains there. I think there's circumstantial, maybe even some more concrete evidence that AI is playing a role in terms of productivity gains. You can kind of feel it, and you can see it in the tech sector for sure with what's going on in employment there. You can kind of feel it in hiring rates. They're very depressed, and I feel there's a lot going on there. A lot of reasons why that might be depressed, but I think one probably is that companies, particularly larger companies, are kind of on hold trying to figure out what AI actually means for their workforce. They're not laying anyone off, which is critical, and we should talk about the risks that we might see some layoffs here. But the hiring has been small, and there's been some good research coming out of using ADP data, for example, that kind of connects the dots. But feels like to me, at least in calendar year 2025 that or Q4 to Q4 that on the supply side, the productivity benefits were relatively small. We're still kind of non-farm business productivity growth is still around 2% ish. Even assuming a pretty good number for the fourth quarter, it feels like we're around 2% ish. So I don't sense any pickup there. But that I'll end here. I think that's going to change. I think here in 2026 we're going to see a lot more on the supply side of the economy as well, meaningful pickup in productivity gains.
Okay. Thank you. Natasha, I'm going to bring in, feel free to react to what Mark said, but also my question for you was this bubble or boom debate is kind of like a big topic, and I kind of want to sort of define our terms. So can you briefly explain to us what a bubble is? How would you define it? And why do economists care about it? To help the audience who may not be as entrenched in the macroeconomic debates that a lot of us are in already.
Great. And I'll do that, and I will intersperse some reactions to Joseph and Mark's great comments. So when I teach about bubbles to my finance students, what I typically say is that a bubble can happen in any type of asset market where the price increases really dramatically, very quickly, in a way that feels untethered to some sort of fundamental value. And like an example that I like to give has to do with the dot-com bubble or the internet revolution, which was also really dramatic and productivity enhancing technology. But what happened is that you had a bunch of companies, and pets.com is like an infamous example of exactly this phenomenon, where essentially like having like adding like .com to the name of the company. It wasn't as simple as that, but because there was so much demand for investment opportunities in this part of the economic ecosystem, money kind of fled in even to ultimately like unprofitable ventures. And that eventually bubbles correct themselves, right? And eventually they burst, and that burst can have really significant ramifications for the broad-based economy, for things like financial stability. If you're talking about the real estate bubble and the lead up to the financial crisis. What's interesting about this particular moment, and I've seen Paul Kudrowski has made this point in a pretty eloquent way. It's almost like a meta, like it's a bubble of bubbles potential that you have in AI, because alongside the possibility that you're having these really dramatic investments, and I agree with Joseph, they're not sort of all that dramatic when appropriately scaled relative to some historical moments, but they're very significant. And you have these very significant investments happening across the economy and artificial intelligence. And you're in a moment of loose credit, which typically does actually predate bubble type dynamics in the economy. And you're in a moment where part of what's happening with respect to the AI infrastructure build out has the feeling of something that might very well look like a real estate bubble, particularly with data center construction and what that's doing to tech hubs around the country. And you're in a moment when you might well be seeing the type of like pets.com kind of dynamics with a lot of these different AI companies and a lot of these different AI investment opportunities. We're really trying to distill and disentangle between them and identify the ones that are likely to be winners or likely to be losers ultimately, even if we do get these broad-based productivity gains that Mark is speaking of, is just like a really hard thing to do at this moment. And so all that is to say, I think people are totally right to be somewhat nervous about the possibility that there are bubble-like dynamics in artificial intelligence. The sort of challenge is identifying both exactly where that is happening in the economy and also identifying when, to the extent you're gonna, I mean, your economists, have predicted 10 of the last 7 recessions or whatever the phrases that we always use. And so inevitably, eventually there will be a downturn. Eventually there will be some sort of market correction, whether the precipitating force is artificial intelligence over the course of the next year or something that's on the horizon that's connected to it or something that's totally distinct, is ultimately really, really difficult to identify ex ante.
Right. Yeah. Bubbles are hard to predict. I remember it being 9 of the last 5 recessions were what economists predicted. But yeah. So, Joseph, you're an economist who has tried to predict the bubble question. So I tried to replicate the analysis you did, hopefully somewhat accurately, in one of your recent pieces at Goldman Sachs. And I counted 5 variables that you paid attention to try to answer the bubble or boom question. Tell me if I got these correctly. So the amount of CapEx spending, the adoption timelines or the productivity gain timelines, or let's just call them timelines, productivity boom or boost that we see from it, discount rates, which is sort of a technical finance term in terms of how we evaluate productivity gains from how risky or not the investment that captures it is. And fifth is the amount of money that goes to investors versus workers, or this capital labor share. Did I get those 5 correctly, Joseph?
Those were the 5 things that we focused on, John.
Yeah. Okay. So let's dive a bit into some of those more. So productivity, your estimate is 15% with a 2-year lag. What's your basis for getting such a lag and then the 15% number? Like, how'd you go about like calculating that?
Yeah, the 15% uplift productivity following full adoption of AI. And I should emphasize that, that 15% uplift assumes that all the work tasks that AI will ultimately be able to automate are automated. We arrived at that estimate by using the ONET database, which basically contains a rich set of tasks that workers in over 800 occupations in the US do on an everyday basis. And we went through and classified which ones were likely automatable and which ones weren't. We then rolled it up into an estimate of the amount of time savings that each worker was likely to experience and translated those to productivity gains. And after doing this exercise, we came up with a baseline for a 15% uplift to, the overall productivity level in the economy. I'd say that the early evidence, if we look at case studies where AI has been appropriately deployed, the numbers look a little bit higher than that. I do expect that the implied productivity effects will come down a little bit as we move away from automating easy to automate tasks, so things like coding, into some of the more complex work tasks that AI will ultimately be able to automate. But for now, the evidence that I'm seeing come in suggests that something like a 15% uplift to productivity following full adoption seems reasonable.
Okay, so I find the productivity question to be like one of the central questions on whether this is a bubble or boom, or at least sort of like if you get a positive ROI, return on investment. Natasha and Mark, do you have any thoughts on the productivity numbers that Joe gave, or just a different way of thinking about it, or any
Can I just
reactions?
react a little bit to I think it's super interesting work that Joseph and his colleagues have been doing. I mean, one point which he emphasized there, but it's just like quite important to re-emphasize, is his sort of productivity estimates are based on an expectation of full adoption in the economy of these types of technological capacities. And like so far, I will say what we've seen is like really quite far from that type of full adoption world, right? And so my colleagues and I at the Yale Budget Lab have been thinking about exactly trying to trace. We know where there are exposed occupations across the economy to the possibility of potential automation due to artificial intelligence. And if there was some sort of like very significant impact with respect to the labor market, which is a little bit precipitating of some very significant impact from a productivity perspective, you would have started to see there being employment trends that look different in exposed industries relative to those that don't. And we just don't see that yet. And so I'm like, I'm very sympathetic with the overall, and I in fact think it is very likely that you are likely to see productivity gains from artificial intelligence, whether they scope to something that looks like what estimates of full adoption across exposed arenas of the economy based on estimates like those that Joseph produced is likely on any short-ish horizon. I think that's a who knows, there's a lot of unknown here, but that is a tail outcome relative to what my expectation would be.
And Natasha, if I can push you a little bit on that, so shortish, what would you consider to be a reasonable timeline for,
So,
let's say, not maybe full adoption, but like what do you think is close to as full as we'll get?
a fun, there's like a famous saying around the internet revolution, right? That you were seeing the internet revolution everywhere except for the productivity
Yeah.
statistics. And in fact, it took something like 15 years for there to be any meaningful productivity gains as a result of the internet, in that were able to be sort of visibly in the late 90s and the early 2000s as a result of that type of an economic transition. And so like again, I'm like very reluctant as far as we
Yes.
could see next year, right? Mass adoption in ways that look fundamentally different. But I will say we are 3 years from the introduction of ChatGPT, which has changed the way that all of us on this Zoom work and all of us think about training the future versions of us that do the work that we do. And you are not seeing that type of labor market or productivity impact. So whether it could be tomorrow, but I would speculate that you're talking about something that's more like a 3 to 5 year horizon, even for partial adoption. Definitely nothing like what Joseph was saying across every different occupation, across everywhere in the economy where there's potential exposures.
And if I could just jump in and follow up on that, I completely agree that a lot of the benefits that we see in those 15% estimates. And our forecasts are embedded several years out. And, in fact, we have the biggest pace or the steepest pace of adoption occurring in the late 2020s and early 2030s. And so, it's not as if we're expecting that 15% is being realized today. I completely agree. I think we'll get into this later on how much we are seeing today. But the emphasis on full adoption, and that's a future outcome, not a today outcome, is worth repeating.
Can I
Yeah,
ask
good.
Joseph, is it your
Good.
estimate of 1.5% per annum over the next 10 years? Is that non-farm business productivity growth? That's average annual growth over the next 10 years, 1.5%.
Yeah, it was
Additive. That's additive on top of everything.
it was business sector. When we actually upgraded our GDP forecast, we actually scaled that down a little bit, partly because that 15% number is a gross uplift. The net uplift, when you factor in, take into account that investment in information and communication technology has been accounting for something like 40% of productivity growth over the last 20 years in most DM economies.
I see.
There's an open
Okay.
question around whether or not, AI is purely additive to current investment or productivity boosts from information and communications technology, or if there is a decent amount of overlap. The reality is it's probably somewhere in the middle. But when we upgraded our GDP forecast to take into account a productivity boost from AI, we fully took out the existing ICT contributions.
So if you go to net, what you call net non-farm business, what is your expectation?
I'd
Average
have to
annual growth?
check the number, but if we take that 40% out, we'd be something like 8% of a
So
net.
0.8, 0.9%. That's that you would add that into basically that's your GDP. Instead of 2%, we're gonna go 2.8 or 2.9%, something like that.
And
Okay.
we have it a little bit lower than that at 2.5%, or I think our GDP forecast runs 2.5 to 2.7 at the end of our forecast horizon. But to Natasha's point, that's not something that we're expecting today.
Right.
It's like from 2027 to 2037, you see 1.5% sort of like annualized over that 10-year period.
Well, you know what I find fascinating on this issue of productivity is there's just massive, just unprecedented in my 35 years as a professional economist, gulf between what economists are thinking, saying, even including Joseph, and Joseph's on the high end of economist estimates of the productivity gains,
Yeah.
and what the technologists are saying, and what CEOs of companies are saying. Now, there's a lot of reasons for that. We're probably thinking about productivity growth in a very different way. The technologists also have a book. They got to raise a lot of capital, so it's got to be transformative. Economists are more cautious. They're slaves to history. They don't like this time is different, and that's what you'd be saying if you bought into the technologists. But it's just amazing to me the differences, and the folks on the other side are sure. They're not just they're absolutely positively sure that we're going to see not 1%, not 2%, like 5% per annum, 10% per annum. These are some really big numbers.
I haven't seen higher than that.
Yeah,
So the range.
it makes me nervous when they're so. I mean, I take it with a grain of salt for sure, but these are smart folks, and they're living it much more than on a daily basis than I am, and they have a very different perspective on things.
Yeah, the ranges I've seen were as low as I think 0.07% a year, which is Daron Acemoglu, MIT professor, Nobel laureate, all the way up to like double digits. I saw even like 20 or even 30% with certain assumptions out there. Those are all technologists who they believe in this strong version of artificial general intelligence, AGI, to get there. So like basically all labor is automated to get there. But yeah, there's a very broad range of productivity estimates, and the economists and the technologists have very, very different views.
Just FYI, we have a forecast, a very explicit forecast, right? We have baseline, we have scenarios. In our baseline forecast, we're assuming the what Joseph calls the net non-farm productivity boost from AI to be about 0.6% per annum over the next 10 years through 2035. So that gets our GDP estimates from closer to 2, maybe even less than 2, to 2.5 to 3. That's kind of sort of where we are. And the biggest impact is later this decade, but I think it's probably going to be, and the reason why is because historically technology's only boosted productivity after businesses formed and optimized around the technology, because legacy companies, and I can attest to this, have a hard time adopting. And it takes a long time to get enough business formation to really move the dial. And that's one reason why you get that solo effect. But this one does feel a little different to me in that regard. So it may not be later in the decade. It may be upon us a lot quicker, which, by the way, and then I'll stop, makes me really nervous in the context of no job creation. We're not creating any jobs now and there's no AI productivity gains. What happens when we get some productivity gains here? If it's in 26 or 27, doesn't that mean job loss?
Yeah. And, just to add, one comment on all this. I think that the discrepancy around the numbers, really highlights, something that I've been emphasizing in my conversations recently, which is, any sort of estimate of the productivity boost that, you're expecting. In ours, it doesn't sound like it's too far off from yours, Mark, with productivity or with GDP growth rising to the mid twos, over the next decade. Um, but these are all numbers that should be taken seriously, but not literally, because no one can really know whether or not, the productivity boost is going to be 15% or 10% or 20%. I think that what has been increasingly clear over the last several years is that this is a significant macroeconomic shock and one that should be taken into account in forecasts.
Yeah. So another thing that I want to bring in, which is part of your analysis, but part of this broader question, is who will capture these productivity gains in terms of like investors versus workers? Joseph, in your analysis, I believe you assumed a 41%, 59% split between investors capturing 41% of the gains and workers capturing 59%. Am I correct about that?
Yeah, I'd have to check the exact number, but basically we benchmarked it to the long run capital share and labor share of output in the US economy. The reason that we did that was that we didn't want to take a strong view on the benefits or who was going to reap the benefits from the economic value created from AI. I could actually make an argument both ways. On one hand, you're seeing enough vertical integration in the tech stack that maybe markups for companies engaged in the build out will be high and that they'll be able to capture an outsized share. On the other hand, the leadership in terms of AI capabilities has been switching back and forth between some of the hyperscalers, pretty regularly for the last 2 years, where OpenAI was in the lead, and then Google was in the lead, and now Anthropic is capturing a lot of the attention. But the point being is that there's a lot of companies engaged in the build out, and it's really hard to know at this point, who's going to be the winner and how much they're going to win by. And so the way that we handled that in our present discounted value calculations was basically just benchmarking against the long run capital share and assuming that that's how much goes to the corporate sector. I think that's actually probably a reasonably good assumption. If you look at the relationship between productivity growth and profit margins at a short horizon, yes, it's true that technologically driven productivity gains do tend to boost margins in the near term. But over the long run, something like that 40-60% split tends to win out over a long history. And since our view on the justification for AI investment is a long run view, taking that long run ratio seemed like a reasonable thing to do.
Okay, Natasha and Mark, do you have any views in terms of whether investors or workers will capture the productivity gains relative to our current baseline?
Yeah, I would say that I think Joseph, I think your estimates are reasonable. I would say, I think I would think about them as almost like a conservative set of estimates, right? Because I think you've heard a lot about how there's a concern, and I know we're going to hopefully get a chance to talk a little bit about tax policy towards the end of our conversation, but you've heard a fair bit about how there is a concern that capital ownership is distributed incredibly unequally in the economy. And this type of technological capacity and kind of like who's going to win from AI is likely to expand that inequity in ways that make us like higher capital share relative to labor share, not sort of constant. And if that's the case, that has a bunch of implications for a bunch of policy questions, including tax. And so I think you're on the, I can make a set of arguments that suggest that actually like the winners are going to be capital holders more likely than they're going to be the labor share. And that would be my best guess, or certainly the guess of those who are most pessimistic about the likely winners of the AI boom.
Yeah, I'm sympathetic to what Natasha said. I suspect that more of the gains are going to accrue to shareholders of these companies and the companies themselves, as opposed to more broadly. Partly because I think businesses, corporations have gained market power in recent years, recent decades. You can see that already in the profit margins of corporations and the share going to labor. It's unusually wide, and margins remain very high, particularly post-pandemic. And I think that does go to market structure, market concentration. So I think that's already embedded going into this. And then I do think historically, when you had new technologies, the way that it kind of diffused is it increased competition, reduced prices, or made inflation less, reduced the rate of inflation, allowed real incomes to rise, which generated real income gains and wealth across the broader distribution, which then generated demand for stuff and created jobs that we couldn't even imagine. And therefore, it all kind of worked out. You had the losses over here because of the technology. You had the gains over here because of the increase in wealth and consumer spending, and they netted out to something close to zero labor market effects. But it just doesn't feel like, at this point, that's kind of the way it's going with AI. Now it can change, and the barriers can come down, and maybe the scale doesn't matter as much as I think it does, but it feels like it does. And if it does, we may not get the same kind of dynamics play out here, and that again leads back to the concerns about what does it mean more broadly for the economy and jobs, particularly here in the near term.
Yeah, yeah. I just to give a few of my own thoughts, I think job displacement, which is likely going to be occurring, will weaken the workers' bargaining power. So I think that could like shift it more in favor of investors versus workers. But then there's also this question of whether the AI labs have much of a moat, or if there's going to be a lot of competition between them, giving low switching costs, which seem to be the case, and less network effects relative to, say, like Facebook and Google of the previous generation. So those are factors I think about when trying to determine like the investor versus worker share of these gains.
Yeah, and to just, piggyback on that, two events, uh, you know, one last year, one this year, that I think are relevant to bear in mind for this conversation is last year we had the DeepSeek event where all of a sudden it looked like the moats were eroded overnight when, the news broke that DeepSeek had constructed a top of the line large language model at a fraction of the cost. And then, and it's a little bit different in that it's focused on a different sector, but the software disruption theme that has dominated markets for the last several, weeks. I think it all really just highlights that, the distribution of gains, across companies and, likewise across companies within and workers, and even within workers, is it the case that a few people are going to get more productive and others fall behind, or is it more evenly distributed? There's academic evidence pointing in both directions, and the distribution of gains is very hard to have a lot of confidence on at this point. And this kind of echoes Mark's comment at the start that there's a lot of uncertainty around the outlook.
Yeah, I strongly agree with the high uncertainty. So moving into sort of like, okay, so we discussed how to evaluate this bubble or boom question, but then there's also a secondary question people ask about sort of the systemic issues that might arise. So Natasha and Mark, you have both sort of expressed some concerns about financial fragility and systemic risk in this context. Can you both explain what specific things about the AI infrastructure build out have made you concerned about the stability of the financial system? And please let me know if I mischaracterized your thinking.
Go ahead,
And
Natasha.
yeah.
Sure. So I think the AI infrastructure build out and its financing is part of a broader story about financial stability that seems like pretty important to me at this moment. And particularly what you saw in the aftermath of the financial crisis was a shift from bank-based lending into a bunch of the financial sector actually being sort of operating in the term of art was shadow banking and now has become private credit. But the essential idea is that a bunch of lending is fundamentally happening outside of the auspices of this like incredibly well regulated structure that had a bunch of challenges in the lead up to the financial crisis. But a lot of those challenges Dodd-Frank and its progeny tried to address by, for example, having higher capital requirements for financial institutions that made it more costly for them to make risky bets. Now those risky bets are happening more and more outside of the traditional financial institutions. And in fact, you have these private credit firms, they advertise themselves as doing this, right? They say, like, what we are doing in part because we do not have the regulatory costs that banks do as we think about the types of loans that we are going to make ourselves or the types of securitization that's going to happen that's facilitated by us. Like, we don't have to think through or factor in those type of costs, which is part of how we are able to offer something like equity-like returns for debt-like risk. And when you hear terms like that, you kind of are a little bit nervous about what that means practically because it feels a little bit like what it might mean is some sort of regulatory type of arbitrage. And I don't want to like overstate this point because what private credit firms will tell you is they will say they're actually, it makes sense that they're kind of thought of as fundamentally different and treated differently than financial institutions in the ecosystem because they're exposed to different kinds of risk, right? They do not have depositors who are going to run to them and say, oh, I'm a little bit nervous about what financial stability is looking like at the moment, and I'm worried that I'm not going to be able to collect my deposits tomorrow, so I'm going to collect them today in ways that require fire sales that can then fundamentally bring down financial institutions. But I think that there's a very sort of a potential, and particularly with respect to some of these artificial intelligence investments, where a lot of it is happening in structures that really sound a bit like the financial crisis redux, right? You're doing a lot of securitization. You're doing a lot of off-balance sheet type of debt maneuvers facilitated by these private credit firms, such that there just isn't much transparency in the ecosystem, even to the investors themselves, about the likely sort of risks or the likely credit risks or the likely profits associated with particular types of investments that make me at least a little bit uneasy as you're watching it all and make you wish in some sense that there was more of a regulatory parameter that was sat on top of in a way that allowed it to oversee some of these types of activities more clearly.
Thank you, Natasha. And Mark, do you share similar concerns? You want to add to that or maybe give a different take?
Yeah, I share the same concerns. I mean, I think there's three contributing forces here to concern about systemic risk. One is valuations. They're high. I mean, it's not just in the equity market, and they're quite high in the equity market, but you know, they're across the board. The corporate bond market, credit spreads are about as thin as they ever get, at least last time I looked. You can see that in precious metals prices, crypto prices, they've corrected, they've pulled back, but they're still, you know, quite high by any historical measure in the context of where's the fundamental value. So I think valuations are extraordinary. Then leverage is building. You know, a lot of it was equity driven a year or two ago, but increasingly it's debt, and that's where the private credit, you know, is coming in. And the structures are increasingly more complicated. You know, there are obviously efforts to get the debt off the balance sheets of the hyperscalers, and you know that always makes me nervous in the context of the lack of transparency that Natasha talked about. And then you have a lot of circularity in the financing and funding, and you know, it's very difficult to disentangle all of that. And then there's very little oversight. You know, the private credit is outside the perimeter of regulatory perimeter, pretty much. And just more broadly, the regulation of AI is just not happening, you know, in the current context. And you know, when you have that kind of mix historically, that can go on for a long time, but it ultimately ends badly. So you know, I do worry about that as a risk. You know, I'm not sending off I wouldn't send off red flares now,
Yeah,
but I'd send off some yellow flares. And if the direction of travel continues, maybe some red flares should be going off a year or two from now. So yeah, I think this is another concern in the context of, you know, what's happening with AI.
great. Joseph, feel free to jump in if you want to agree or disagree or do something. Otherwise, I'm going to ask about policy implications. So, Joe, it looks like you may want to say something.
Uh, no, very brief. I just would echo Mark that, the 1 to 2 year, potential issue is very much in line with our view that, it doesn't look like we're in a 1999 backdrop. We're now with, corporate profits being high and, debt looking low. But that could change if we continue on the path that we're on. And so it's worth monitoring, but it doesn't look like we're having instability issues right now.
Okay. So I'm going to ask about policy implications, but before I do, for the audience, if you have any questions, again, feel free to drop it in our Zoom or on Twitter, and we'll ask. And I already see several questions. But with that, Natasha, do you want to talk about the policy implications or what you would tell policymakers regarding some of the concerns you have, what they might be able to do if they, are listening to you right now?
So I have but and I think we've started to gesture at the possibility that some of these productivity gains could be on the heels of automation that thus displaces at least certain types of workers in certain sectors in the economy. And so if you're thinking about this sort of broad-based landscape of what you might want to do as a policymaker in anticipation with all of this uncertainty and all of these caveats that we're seeing about the possibility that it is hard to identify exactly precisely the timing when you're going to start to see some of these impacts. If you ask me, like, what one should do that is like obvious, no regrets type of policy making, for me, that's twofold. The first is that I think no matter the nature of, even frankly, right now at base case, even without these massive productivity gains and potential labor market displacement from AI, I think we are in a situation where fiscally we are incredibly constrained by the fact that we are not capturing as much revenue as we need to finance the government that we currently have. And if you do have broad-based labor market displacement, you are going to be in a situation where you need to invest more and create more fiscal space to address those types of issues. And so, like, an obvious no regrets thing to do is to right the fiscal ship and to figure out ways, in my mind, to be able to raise more revenue through a host of different choices that one would make, I suspect, that are in the direction of getting better at taxing capital, taxing corporations at higher rates, figuring out what to do about multinational taxation, all of which is likely to have a really substantial and positive effect on the economy from a revenue perspective and from a fiscal perspective. The second thing I would say about AI particularly is I think we've all seen a lot of policy proposals that are seeking without sort of very clear precision about exactly what problem they're trying to solve or where they're likely to see this type of labor market displacement, like wanting to craft like creative types of new policy instruments. And my sort of view is like, and is maybe a bit of a boring or technocratic one, is like we have the tools that you need in order to, or at least some tools that you might need in order to address these type of problems, and trying to figure out how to tighten up the social safety net as it exists by doing things like having an unemployment insurance system that is better equipped to help people navigate long spells or potential long spells of unemployment, getting much better than we are in this country. We spend a fair bit of money on worker training, but we are not very good at training people for upskilling people, training people for new types of jobs that emerge in the economy. And so, like, figuring out how to do those types of things better strikes me as, again, like obviously no regrets types of investments. And in fact, if you can use this AI moment as a way, almost like an entry point to do a lot of this like shoring up of social safety net that many of us on this call have wanted to see for a long time, like that would be really good policy that would be value additive for the world in any state of how the AI ship ultimately lands.
Great. Mark or Joseph, do you guys want to add or sort of give a different take?
It was well said. No, I don't have anything to add. No.
You're muted, Joseph.
I was just going to say one policy call out that is a little bit separate that I would vote for is increasing funding on measurement of how AI is impacting the economy.
For that.
Because the Census Business Trends and Outlook Survey does a great job of measuring it on a bi-weekly basis, but economists, researchers generally like having more data so we can look into this. And this is a very important topic that I think is worth measuring properly. And it's a as a result, I see it as a policy issue on that front.
Unfortunately, there's a long list, isn't there, Joseph? Of like the CPI, maybe payroll employment. So like, okay.
All right, I'm going to get some audience questions. So one of the ones I see is Eric Brynjolfsson, a Stanford professor, published a piece in the Financial Times claiming that the AI productivity takeoff is finally visible. At least that's the quote in the question being asked, basing this on, quote, new figures reveal that payroll growth was revised downward by approximately 403,000 jobs, a bit of a longer thing, but I don't know if you've seen this Financial Times piece. But Eric Brynjolfsson's a very well-respected name in this space. He actually was at our last event, and he's on the board of advisors for ARI. Are you guys seeing any signs that make you think that productivity gains have started to show up in these statistics? And let's do quick answers to this, yes or no with a short explanation, or you don't know.
I read the short op-ed, and it's intriguing. What he's saying is, we're going to get we got these big downward revisions to jobs. So if GDP stays where it is, we're going to, ergo, we're going to get a big increase in productivity. Maybe we'll have to see how all the revisions, because GDP gets revised too. We'll just see.
Yeah.
But the other thing I'd point out is productivity growth in 2024 was 2.7%. So even with those downward revisions, I'm not sure it's going to be higher than that. So I don't think we'd say AI was affecting productivity growth in 2024. So I'm not so sure,
Okay, to give people context,
it's suggestive, but it's not proof positive. No.
Yeah, to give people that perspective on that 2.7%, how's that compared to previous years?
That's very strong. I mean, typically, on average, since World War II, it's about 2%. And then in the wake of the financial crisis up to the pandemic, it was 1.5%. Since the pandemic, it's been, closer to 2. So 2.7 is that, at the height of the internet boom, we got to 3 on a consistent basis. So that 2.7 is a pretty strong number.
Okay. All right, I have 2 questions, which I don't know if this is the same person, but they're asking about startups by 17-year-old kids, and both of them have the 17-year-old number. I don't know if that's the same person asking the question, who claim billions of values for startups without any real value creation for the economy, according to the question person. They would like to know what would happen to some of these startups that don't look like they're going to make it if, I guess, the revenue or customers fail to materialize.
I can take a stab at that. I would say that it's kind of a classic, startup story that I don't think it's really necessarily AI specific. That, a lot of the investment, a lot of the capital that's being allocated to AI today is in anticipation of future growth. And, we're not seeing a large impact on the labor market today. We're not seeing a large impact on productivity today. I completely, agree with Mark's assessment on that front. And so, the question is, are you, or the valuations and the capital that's being allocated to AI is being done because you anticipate in the future there's going to be a lot of value created that, can ultimately translates to higher revenue growth for businesses. If that doesn't materialize, then, I guess there's 2 ways that it could play out. One, if the whole AI, excitement or the whole AI story turns out that it's unable to deliver significant productivity gains and have significant, impacts on the economy, then, all the CapEx would go to waste. The other option is that it's quite possible that, some of the companies that are making the investments today and, receiving a lot of investment might not ultimately be the long run AI winners. And in that case, I don't think it's necessarily a bad story for the macro economy, because you end up, building out infrastructure that's going to be necessary anyway. And history has shown us repeatedly that it's often the fast follower or the second mover that's able to capitalize on a lot of the infrastructure build to generate significant economic value. And so, obviously, if, just to wrap up, obviously, if, AI doesn't deliver on its promises, then, there will be a lot of capital wasted. But, just because one company doesn't win or wins or does not, doesn't mean that, the macro story is not intact.
John, that brings up another point that, AI might fall flat, but the reasons might be very different. It could be the negative externalities created by AI overwhelm the benefits. Cybercrime, identity theft. We're going to invest a lot more in defense because we're going to have to protect ourselves from nefarious actors, or people could use it for malintent and do a lot of damage. And you think about the risk premiums you'll need to embed into everything to account for that potential threat. That doesn't become real until something actually does happen, but it would be surprising if something doesn't happen at some point. So, you could there's a gazillion scenarios here. And one of the scenarios is that AI doesn't really go as far as we think it's going to go because it creates all these other issues that we're going to have to grapple with.
Great, and that gets me to the next question someone asked, which is the strong AGI scenario. So what would you envision happening to the economy if a frontier lab unequivocally achieves artificial general intelligence with a clear advantage over the other labs? So let's take instead of AI not doing anything, the opposite, where you get strong form of AGI. Anyone want to take a stab at that one?
I can take a stab because we haven't written anything on AGI, mostly because I find it hard to conceptually discipline any sort of forecast. Clearly, if you do see the way that I would think about AGI translated back into economic terms is a acceleration in the growth of TFP. Where over time
TFP
innovation is building
is-
on innovation and building on innovation, and as a result, GDP growth is accelerating. Now, we've all seen the charts that look at the singularity point where growth is accelerating so much that everything becomes so concentrated that you just explode. I clearly growth would be higher. Clearly, the company that if there were to be one that developed AGI would generate a ton of economic value. But that's pretty far outside of most economic models that we typically focus on. And furthermore, it's if you look at expert polls on the likelihood of AGI emerging, it does suggest that it certainly should not be the base case, at least in the forecast horizons we typically focus on.
Okay.
I share Joseph's difficulty in commenting about AGI, in part because it is hard to even sort of have a coherent view of what AGI would mean. And I think that it's so funny that that's our view on this panel, because if you assembled a group of technologists to talk about this question, they would have a dramatically different view, right? But one thing that seems important to me is that and this is again unsurprising given that I am looking at things through the lens of an economist, if you think about the development of AGI or that type of high level capacity to essentially automate everything that workers are doing in the economy today. I was on a panel thinking about these issues with Anton Kornick and David Otter, where Anton kind of suggested maybe that means it's the end of the industrial age, in the sense that maybe you no longer really labor has always been our scarcest input into the economy, but in that world it's not anymore. And I just think that has such fundamental consequences. I think that's a tail case. I think you can't assume that that's going to be the way where the world lands, any of that. I'm just saying, if that is the world, it's both hard to really understand how to think about right now, and also as you think from what kind of advice would you give policymakers, I find it very difficult to try to speculate on the types of policy tools one would need in that world, because it looks so fundamentally different than any past moment of computerization or any other type of technological revolution where labor scarcity were ultimately still the underpinning sort of frameworks of how the economy functioned.
Okay. Mark, do you have anything to add?
No, only to say that economists are completely mal-suited to answer that question, right? Because
So
we
true.
are we are we are slaves to history. The models that we use, the econometric models, are based on historical precedent, and we've got a lot of precedent. We've had other technologies come along here in the last, well, since World War II that we were able to capture in the data as well as we can and model. But the kind of scenario you're painting is one that's just outside of any historical experience by more than a little bit. It's like a lot. So the tools we have, the way we think about things, just aren't well suited. Doesn't mean we're right, by the way. It could
Yeah.
be we could be totally wrong. And also we have a pre-economist. Yeah, I mean, I was critical of the technologists because they're talking their book because they need to because they got to raise a gazillion dollars in capital. But economists also have, their own kind of peccadillos. I mean, professionally, if you come out and say this time is different and it's not, you'll get pilloried. It's much easier to say, no, this is not different. This is just a variation on the theme. It's just a much easier thing to do professionally. So, all of this to say is I don't think the technologists are right, but I don't say it again with any confidence.
Okay, so a few things. I feel like economists then have their bias to be more conservative on their
I,
estimates
I
based
think
on what
so.
you're
Correct me if I'm
saying, and
wrong, Joe. Not
technologists, yeah.
Joseph. Joseph swings for the fences. I can.
Yeah, no, that's fair. And then technologists, we probably should have had some technologists to sort of make the case in that direction. And then I'll point out that Anton Kornick, since you mentioned him, Natasha actually has modeled a world with sort of like all labor being automated. And there's some interesting implications of that. I forget what the name of the paper was, but it's an interesting read for people who want to think about that scenario. I see I'm close to time, so if people want 30 seconds to give any final thoughts, please feel free to do so. So, Joseph, do you want 30 seconds to give any final thoughts or something you might have wanted to say earlier but didn't get a chance to?
Um, yeah, I guess I'd just wrap up by saying that we've spent a lot of time, or backing up. There's a lot of focus on the labor market impacts of AI right now, and particularly over the last few weeks at the start of the year, it's been one of the top questions that markets have been focused on. I've spent a lot of time looking for AI impacts in the data, and you can look at the labor market data at a detailed level, and clearly in sectors like call centers or the tech world, or in management consultants, there is a headwind to hiring. But this is a fairly narrow story right now. That doesn't mean it will be narrow tomorrow or in a year or two from now. But it still is very early days in the transition, and I think that that's worth bearing in mind, particularly when the narrative seems to be shifting that we're likely to see widespread disruption in the very near term.
Natasha?
Yeah, I agree with all that. And I will say two other things. One is I think Joseph's call for better data and better measurement capacity is like extremely well heated. Not just like policymakers and the government should invest in those types of capacities, but all of us who are trying to think about these issues and trying to make more data available on more answers to these questions in real time strikes me as like very value additive. And the other thing is like, in some sense, I'm a little struck by your last comment about AGI, Joseph, John, because I worry about I both share the sort of like views of my co-panelists here that like, and the type of productivity boom that they've described is like basically like the internet revolution, right? We went from productivity growth of about 1% to productivity growth of about 3% really rapidly over the course of a period of years in the late 90s. I think that's the likeliest outcome, but that is one outcome and not a tail outcome that many who are not on this panel think we are likely to see. And I think giving some more thought to what the policy implications of those tail outcomes are likely to be seems important to me.
Okay.
Hey,
And
John,
Mark?
so thanks very much for the opportunity. It's great to be on with the panelists. I just want to say I've got a white paper coming out next week on AI, the macroeconomic consequences of AI. So go through a lot of different scenarios, all rooted in kind of the economist perspective. I kind of push the other over here and I talk about it, but I don't address it. So I'll send that along to you, and you can feel free to pass that along to folks, and hopefully they'll find it of some value.
Great, great. With that, I'm going to wrap this up. Before I let the three of you go, I want to just thank a few people who made this event possible who are not on the panel or on screen. So quickly, I want to thank Chris McKenzie, Q Chuktai, Kirsten D'Souza, and Noah Frank for all the work you put in to help make this event possible. With that, I want to thank you, Joseph, Natasha, and Mark, for joining us for this fascinating discussion. And also thank the audience for tuning in. With that, thank you, everyone, and look forward to seeing you next time.